Let's break down what a CTA is and why they're such a big deal in the world of finance. You might have heard the term thrown around on financial news or in investment circles. But what do these mysterious CTAs actually do, and why do they matter so much? CTA stands for Commodity Trading Advisor. But don't let the name fool you. They trade way more than just commodities. In fact, the name is a bit of a misnomer, because CTAs are involved in a wide range of global markets, not just things like oil, gold, or wheat. Think of CTAs as massive, computer-driven funds managing billions of dollars. They're not your average investor sitting at home with a laptop. These are institutional giants, often with teams of mathematicians, programmers, and market experts working behind the scenes. Their main job? Spot trends in markets and make big bets on where prices are heading. They're constantly scanning for opportunities, looking for patterns that suggest a market is about to move in a big way. They trade everything: stocks, bonds, currencies, and, yes, commodities. If it's a liquid market with enough volume, chances are CTAs are active there, moving huge amounts of money in and out. The secret sauce is their computer models, which scan for patterns and generate buy or sell signals. These models are built using complex algorithms, often refined over years, and are designed to remove human emotion from trading decisions. When a market moves consistently in one direction, their models tell them to jump in, buying on the way up, selling on the way down. This is called trend following, and it's at the heart of what most CTAs do. It's all systematic and rules-based, not about gut feelings or news headlines. Every trade is executed according to a strict set of rules, often with little to no human intervention once the system is running. These systems are constantly updated and improved as CTAs compete to find the best ways to capture trends and avoid false signals. It's a high-tech arms race, with firms investing millions in research and technology. CTAs are like giant ships. They need a strong current or trend to move. When markets are choppy or directionless, they might sit on the sidelines, but when a clear trend emerges, they can move enormous amounts of capital very quickly. Unlike traditional investors who buy and hold, CTAs chase momentum, reacting to price action, not predictions. They don't try to guess the future. They follow what's actually happening in real time. Their approach is all about following the flow, not fighting it. If the market is moving, they want to be on board, riding the wave for as long as it lasts. So, CTAs are the market's trend-chasing giants, moving billions based on what's actually happening. Their trades can influence prices, and their presence is felt across global markets. And when they move, the whole market feels it. Whether you're a small investor or a big institution, the actions of CTAs can ripple through the financial system, shaping trends and creating opportunities, or risks, for everyone involved. Why does it matter what CTAs are up to? Simple. They control hundreds of billions. When they buy or sell, markets move, sometimes dramatically. Their actions can turn a small rally into a surge, or a dip into a plunge. Analysts and investors track CTA positions to gauge market momentum and risk. If CTAs are fully invested, there's less fuel for a rally. If they're on the sidelines, a lot of buying power could come in. Their moves can trigger sudden drops or sharp rallies, creating whipsaw markets. Understanding CTAs helps you see where the big waves and risks are. It's like knowing where the sharks are in the water. You can't control them, but you can avoid getting caught off guard. Let's recap what's happened in US stocks lately. The S&P 500 and Nasdaq were shaky, with sharp drops that spooked investors, exactly the kind of chaos CTAs hate. Then suddenly, both indexes rallied for 5 days straight. For CTAs, that's a powerful buy signal. Their models love clear, consistent trends. This rally pulled markets off their lows and brought relief to investors. For CTAs, the why behind the rally doesn't matter. It's the what, a clear, sustained rise. Before this, their models likely said, stay out or sell. But 5 up days flipped the switch, especially for short-term models. The signal changed from avoid to buy, and CTAs had to follow their rules. When the trend is clear, they move fast. That's how systematic investing works. See the trend, follow the rules, deploy the money. And that's exactly what happened. After the rally, CTAs started buying back into the S&P 500 and Nasdaq, re-establishing long positions. But here's the catch. Many missed the most profitable part of the rally. Just before the rebound, a sharp drop triggered their stop losses, forcing them to sell at the bottom. They got kicked out right before the music started. That's the risk of trend following. Models protect capital but can get whipsawed by sudden moves. CTAs only bought back in after the trend was obvious, meaning they paid higher prices. Even the smartest strategies can get caught by unpredictable swings. Sometimes the party starts without them.
CTAs are buying stocks again, but they're cautious.
The reason? Volatility. Big, unpredictable price swings. High volatility confuses their models and increases the risk of whipsaws. When markets are choppy, CTAs automatically reduce their position sizes to manage risk. Even if their models say, buy, volatility acts as a brake. Think of it like driving. Smooth roads mean you can go fast. Bumpy roads force you to slow down. Right now, the market is still bumpy, so CTAs are keeping their bets small. For them to ramp up buying, volatility needs to drop. If daily swings calm down, their systems will let them invest more. Until then, their buying power is capped. Volatility is the key factor holding them back. The market's next big move depends on whether things settle down. What could calm volatility and let CTAs buy more? The year-end holiday season. Trading usually slows down, which can make markets calmer and less volatile. If the market drifts up or sideways without big drops, volatility falls, and CTAs get the green light to increase positions. But any shock, like a surprise from central banks or bad economic news, could spike volatility and force CTAs to sell. The path forward is all about stability. A gentle, steady market is enough to keep CTAs buying. If choppiness returns, they'll stay cautious. It's all about waiting for a smoother ride. CTAs don't just trade stocks. They follow trends across all markets. These systematic traders are constantly scanning the financial landscape, looking for opportunities in everything from equities to fixed income, commodities, and even currencies. Their strategies are designed to be flexible, adapting to whatever asset class is showing the strongest momentum at any given time.
Take U.S. Treasury bonds, for example. In recent months, these government-backed securities have become a focal point for many CTAs. Yields have been falling, prices rising, and CTAs have been steadily increasing their long positions. This means they're betting on bond prices to keep climbing as interest rates drop. Their models show a stronger, more established trend in bonds than in stocks. The signals are clear, and the momentum is hard to ignore.
They're following the money, and right now, bonds look solid. The consistency in the bond market is giving CTAs the confidence to keep adding to their positions. Gold's also on their radar. As a traditional safe haven, gold often attracts attention when uncertainty rises or when inflation is a concern. Volatility was high, but it's calming down, so CTAs are rebuilding long positions. As the market stabilizes, their models are signaling that it's time to get back in. They're not as heavily invested as before, but the direction is clear. The trend is pointing upward, and CTAs are positioning themselves to benefit if gold continues to rise.
As long as gold stays stable, they'll keep adding. If the price holds or moves higher, expect more buying from these trend followers.
Copper's trend signals are improving too, so CTAs may start buying there as well. Industrial metals like copper can be a sign of economic strength, and when the trend turns positive, CTAs are quick to notice. Their approach is the same everywhere. Find a trend, check volatility, and invest accordingly. It's a disciplined, data-driven process that helps them navigate complex markets. It's not just about stocks. Bonds and commodities matter too. CTAs are always looking for the next big move, wherever it might appear. The current environment is a broad story, not a single market play. Multiple asset classes are in motion, and CTAs are ready to capitalize on any emerging trend. CTAs are trend followers, wherever the trend appears. Their flexibility and focus on momentum allow them to adapt quickly, making them a key force in today's ever-changing markets. When markets get wild, some look to the options market for stability.
Big banks hedge their risks using options, which can sometimes dampen volatility. This is called positive gamma. In theory, it acts like a shock absorber. If markets fall, dealers buy stocks. If markets rise, they sell, smoothing out moves.
But right now, this stabilizing effect is barely working. Bank of America says the impact has been tiny, like stopping a tidal wave with a sandbag. The forces driving volatility are just too strong.
So we can't count on options hedging to calm things down. The market has to find its own stability. Until then, volatility stays high and the path for CTAs remains tricky.
So, where does this leave us? After a period of uncertainty, investors and traders alike are searching for clarity about what comes next. The landscape is shifting, and everyone is watching closely to see how CTAs will navigate the changing tides. CTAs are back in US stocks, but they missed the first leg of the rally and are still wary because of high volatility. This hesitation is understandable. Recent market swings have made even the most seasoned professionals cautious. Many are still analyzing what they could have done differently and what lessons can be learned for the future. Their risk models are holding them back from bigger bets until things calm down. These models are designed to protect portfolios, but they can also mean missing out on big gains if the market turns upward quickly. For now, caution is the name of the game.
If the market stabilizes, maybe thanks to quieter year-end trading, expect more CTA money to flow in. Historically, calmer periods have encouraged CTAs to increase their exposure, which can add momentum to ongoing rallies and help support prices. If volatility spikes again, they'll pull back just as fast. Quick reversals are part of the CTA playbook, and they won't hesitate to reduce risk if the environment turns choppy. This means investors should be prepared for sudden shifts in market direction.
Meanwhile, they're confidently buying bonds and cautiously adding to gold and copper. These assets offer diversification and a hedge against uncertainty, which is why CTAs are increasing their allocations here, even as they tread carefully elsewhere.
They follow trends wherever they find them, not just in stocks. Whether it's commodities, currencies, or fixed income, CTAs are always on the lookout for opportunities, adapting their strategies to whatever the market presents.
For investors, the return of CTAs is a positive sign, but the market is still on edge. There's a sense of cautious optimism, but also a recognition that risks remain, and the path forward is far from certain. Watch volatility. If it drops, CTAs will buy more, which could help your investments. Lower volatility often signals a more stable environment, encouraging more participation and potentially boosting returns for everyone involved. But with market shock absorbers not working well, things could get bumpy again. Sudden downturns can still catch investors off guard, and the safety nets that once softened the blow may not be as reliable as before. The road ahead depends on whether calm or chaos wins out. As we move forward, staying informed and flexible will be key to navigating whatever comes next in this ever-evolving market landscape.